Chevron came out with earnings that were quite a bit stronger than the street was expecting. We knew things would be better. What did the street miss there?
We're a better company than we were just a few years ago. Our costs are lower, our production is higher, we're much more capital efficient, and we have a clear strategy and objectives around delivering higher returns and lower carbon. The outlook is positive, demand for our products is strong. We expect more recovery as office commuting, international travel, and business travel pick back up, and we raised our buyback to the top of our range.
You know, the free cash flow number, $6.7 billion is the best number that the company has ever reported. And yet at the same time, CapEx down by 22% for the year to date. A lot of that has been because investors were kind of signaling they didn't want to see more money put into oil and exploration. Numbers for oil. They didn't want to see things going to other places. Maybe they wanted to see renewable futures and they wanted to see money coming back to shareholders. You think that's still the case with oil prices above $80?
We can do all three of those things. First of all, we're growing our traditional business. Our production was up 7% this quarter versus the year ago quarter, and our capital will go up in the fourth quarter and next year. We expect our capital next year to be at least 20% higher than where we'll end up this year. We haven't announced our budget yet. We've also announced a tripling of our investments in low carbon solutions, so renewable fuels, hydrogen, and carbon capture. And as I said, we've raised our buyback to the top of the range. And as we pay down a little more debt, and we're fast approaching a very comfortable debt level, we'll be able to increase that buyback range. And that's on top of a dividend that's up 12% since COVID, the highest dividend increase in the sector.
That's really interesting. You haven't announced the spending for next year, the CapEx spending, but it's going to be at about 20%, so 20% above where it was for this year. And a lot of that's going to be going to exploration, or is it going to be going to these new projects more?
It's going to go to our traditional business and our new energy business. We have a guidance range of 15 to 17 billion. So even the bottom of our guidance range of 15 billion would represent about a 20% increase from where we're going to end up this year. So again, we can do both. We're going to invest and grow a traditional energy business, make it high return, lower growth, low carbon, and then the faster growing new energy businesses and renewable fuels, hydrogen, and carbon capture.
There have been so many questions asked. We know for oil prices at $80, a lot of that is the demand picture, but it's also the supply picture. Do you think that lowered supply than we'd been used to is going to continue for several years to come?
We expect markets to rebalance. Demand decreased really quickly last year. It's increasing rapidly this year. It's hard for supply to adjust as quickly, and so you're seeing the price signal work, right? So prices are up. That'll send a signal to rebalance markets, and we expect that to happen over time.
What do you get the sense of just from investors and wanting ESG, really wanting moves to see things moving away from fossil fuels, maybe not spending as much on that? Is it still the same sense when oil's at $80 that it was when oil was, stuff you had to give away, basically?
We're seeing investors come back to the sector. I mean, this is a sector that has underperformed relative to the broader market indices for any time period longer than a year. And so we have work to do to earn a higher valuation. Our message of higher returns, lower carbon, we think is a winning combination. Again, a traditional energy business that's low growth, high return, lower carbon, delivering the energy that's in high demand today and for many years to come, while growing faster the new lower carbon solutions that'll be a bigger part of a low carbon future. We think that combination is a winning one for our shareholders.
Shepard Smith here. Thanks for watching CNBC on YouTube.